Welcome to the Gray Report. I'm your host, Spencer Gray, and today we have a very special guest. Paul Fiorilla, the Director of Research at Yardi Matrix, is here to join us once again on the Gray Report to help us understand kind of again where we are in the multifamily market. Paul is an expert in multifamily, covers the entire nation, and so we'll have some really insightful insights. Without further ado, let's just jump into it. Let's get going. All right, welcome back to the Gray Report. Paul Fiorilla, thank you once again for coming on the Gray Report. How are you doing today?
Great, thanks for having me. Always happy to talk to you guys.
We've been looking forward to it. And one thing I wanted to ask you just as we get started, and I alluded to it just before we press go, is you talk to a lot of people in the industry. You speak at a lot of industry events. And so I'm just curious, when you're having private conversations or conversations with individuals, what are people asking you about? Kind of what is the scuttlebutt in the industry? There's a lot of changing variables, a lot of uncertainty out there. What are you getting asked about more?
Well, I get asked about all sorts of different things, as you can imagine. I think I think that some of the big topics in the industry right now are, the supply pipeline and how quickly it's going down, and whether demand is going to remain as strong as we've had in the last few years, and kind of the general economic uncertainty is certainly a big topic of conversation. Kind of the impacts of all the policy changes we're seeing, um, you know, pricing and what's going on with cap rates and things like that. Those are, generally speaking, a lot of the conversations that I have in here. And some of it too is around, I've been doing a lot in the affordable housing industry, so there's a lot of I a lot of concern about, again, the impact of policies. And we're at a time now when the budget negotiations are going to have a huge impact on the industry and on the affordable market in particular. So those are the main topics, I would say.
Now, I want to jump into the supply story because I think that's clearly a critical driver. It's been a driver of some of the negative rent growth. I think according to the latest Yardi Matrix national report, we saw occupancy see a 10-year peak or drop in occupancy, peak in vacancy. But first, on the affordability side and some of the changes to policy, it's really hard to keep track of all the different policy changes over the last several months. You're probably closer to it than most out there. Can you give us some updates on the affordable housing space right now? Obviously, we've been living through a housing crisis, and if supply does recede, that isn't going to make the situation any better. What are some of those changes to affordable housing policy going forward in the landscape?
Well, specifically, I mean, when we talk about multifamily in general, there's a lot of potential changes to the tax code. I think the House budget that was passed, that's not final. It's got to go through the Senate and then get signed. But the House budget that was passed had a lot of included a lot of the favorable tax treatment, and that the industry has been seeking, and maintains kind of some of the favorable tax treatments that we've had all along. That some of it was kind of concerned that it might go away. On the affordable side, the affordable industry has been pushing for years now for an increase in the amount of money allocated to the low-income housing tax credit program, LIHTC, otherwise known as LIHTC. And the House bill passed a 12.5% annual increase in that allotment. There was concern, they could have done anything, but the industry had been lobbying for, and that 12.5% increase actually had been passed in a bill in the House in 2023, and then it died in the Senate. So that 12% increase, which would increase the amount of funding for LIHTC to something like $14 billion, that passed. So that was, very good for the affordable housing industry. There's still kind of concerns about Section 8 and home and some of the direct subsidy programs. President Trump had proposed in his skinny budget, uh, making those block grants to the states, which would, be kind of bad for the property owners of those things, because that would kind of end the certainty of getting your rent paid. But so far, that was in the House budget, um, and there was kind of a sigh of relief that bad things that could have happened haven't happened, at least so far. Again, we're still not through the entire process.
There's also been conversation just from the policy front of, changes to Fannie Mae, Freddie Mac, potential privatization, even talk of, having an IPO for Fannie and Freddie. Do you have any opinion on, people are a little confused because it had supposedly been on the back burner a little bit. Then all of a sudden it seems like Trump just keeps bringing it up here and there. Do you have any opinions on if something actually, if there's the will to make something happen in terms of privatizing to some degree Fannie and Freddie, but then the impacts, and obviously we don't know any of the details right now, but
Right.
what are the potential impacts? Because Fannie and Freddie have been a supporter of mission-based housing and affordable, small a affordable housing as well. But yeah, curious if you have any what your opinions are on Fannie and Freddie.
There's so many aspects to this, and it's really complicated, but, just real basically, Fannie and Freddie went into government conservatorship during the global financial crisis, mostly because of the single family market, but multifamily, which is a smaller part of what Fannie and Freddie do, also is caught up in that. And, Fannie and Freddie provide, 40 to 50% of, the multifamily mortgages, and they are a backstop to the industry. And the key is that they have the implicit guarantee, of the government. So during the first Trump administration, the FHFA director kind of talked about making Fannie and Freddie private again. But it's kind of complicated because Fannie and Freddie, first of all, in order to make them private, they would have to raise capital, and they've started that process, but they still don't have enough capital to become a private lender, right? If you're a bank, you have to have reserves and to cover for losses, and Fannie and Freddie don't have enough of those right now. Plus, Fannie and Freddie would owe the federal government, 300 and something billion dollars. So if they went private, right, how do you raise that 300 some odd $billion to give to the federal government? Where does that come from? And then there's the issue of, the guarantee. If they are private, do they have the guarantee of the government? Now, President Trump tweeted the other day that that they would have the implicit guarantee. But, that's kind of the way they're operating now. What would be the, kind of the difference? And if they're private companies, do they still support the industry during downturns? Because there's two main advantages to Fannie and Freddie. One is that because of that implicit guarantee, they are a cheaper cost of financing, so they can offer lower rates. And then the other advantage is just that during times of distress, they're still there. They're going to provide liquidity to the market. If they're private, and there's a downturn, will they still be there to provide that liquidity, which I think is the kind of probably even the most important role that they play in the, kind of the mortgage world. So, there's things that can be done by executive order, but in order to change the kind of whole structure of the company, that has to be done through a congressional vote. And it's hard to say whether, I mean, it's doubtful because they haven't had the votes over the last 15 years to make significant changes to bring Fannie and Freddie private. So I don't know. It's very complicated, and I'm sure that the Trump administration wants to bring them private, but we'll see how they do it. Will go a long way toward determining the impact on the market.
Well, it certainly would have an impact, as you said. Almost half of the current, at least market rate multifamily loans are issued by either Fannie Mae or Freddie Mac, and that backstop, slightly lower rates, a little bit better amortization than other commercial banks may issue on other asset classes, has allowed the perceived risk of multifamily to be slightly lower because there is that financial backstop. It almost seems like the Trump administration may see that $300 billion number, and that's an attractive piece that they might like to add to, reducing kind of the overall, deficit and some of their overarching goals less and from a policy standpoint from Fannie or Freddie. But sounds like it's so complicated that the political will may be hard to raise, but certainly will be something
and basically it's not broken. The mortgage markets have operated fairly well in the last decade or so, and so even though there has been in not just the first Trump administration, but the Obama administration, there were thoughts of, hey, we need to bring them back to private status, but it's hard to generate the will to do anything when there's nothing bad happening.
No, very true. If it's not broke, why fix it? And you can really look at the overall strength of the U.S. housing market compared to other nations that don't have a Fannie Mae or Freddie Mac, and are traditionally their mortgage systems are quite a bit different. They're mostly shorter term floating rate loans, or rates that readjust, versus longer term, typically fixed rate loans that are facilitated by Fannie and Freddie. So it's a kind of good point. If it's not broke, why go in and try to throw the baby out with the bathwater?
Other types of lenders, banks, life companies, well, not so much life companies, but other types of lenders, like, well, we don't, it's hard to compete against Fannie and Freddie. We want a bigger share of the market. But if you restructure Fannie and Freddie and you continue the implicit guarantee, then they still have that advantage. So how are you changing the market dynamics of the competition between lenders? Again, it's we'll see.
Yeah, it certainly would change the equation. So let's shift a little bit more to specifically some multifamily operations performance. Looking at the latest Yardi report for April, saw some modest rent growth, about $5 on average nationally. I think up year over year 0.9%. So positive number, which is good, but we typically would expect a positive number in April, and certainly a weaker April compared to previous years, especially pre-pandemic, where we typically see kind of rising traffic and demand March through June and July, depending on the market. Weaker April, can you kind of help us unpack that a little bit? What we're seeing, how much of this is sentiment? What are your thoughts on the market right now going into leasing season?
Look, the multifamily market has, in my view, kind of continued the momentum it had coming into the year. Not that everything has been perfect, but we've had generally strong demand in recent years. Last year was really good, and this year we started out, absorption slowed a little bit, but it's still positive, still fairly good. And the general story has been that the markets with high supply have, like, rent growth has been highest or in the Northeast and the Midwest, and because demand is moderately strong in those markets. It's strong everywhere, but the Northeast and the Midwest, they don't have the supply growth, so rents are still going up 2%, 3%, 4%. I think New York has been up 5% year over year. Meanwhile, the Sunbelt markets where strong demand is even stronger, but because the supply is even higher than the absorption, rent growth over the last, 15 to 18 months has been negative year over year. Renewal rents are still going up, and that kind of is a sign that, the market has some firmness. But because there's so much new supply, that's for new leases, that's created sort of a downward pressure. So that's been the story. It still continues to be the story. So this spring, yeah, rents continue to go up. I think I just got the May numbers last night. Our preliminary May numbers showed, May was another good month. Rents went up fairly decently. So, the question, the question for multifamily is, how rapidly is the supply growth decelerating, and how long will, the demand remain as firm as it's been?
And what are your thoughts on that? I mean, I think there's a little bit of recency bias that, Midwest and Northeast are, the outperformers right now, but that most likely won't go on forever. When will we likely start seeing a change of story for the Sun Belt? When will Austin start posting some positive numbers after, going on 2+ years of kind of negative growth? And every market is different on the kind of
Right.
their supply curve. But when does that story and narrative start to change a little bit?
Well, that's the big question, because, Austin is an extreme example, right? Austin's, had like 6, 7, 8% supply growth over the last couple of years. And, but, but there's a lot of markets. There's about 12 or 15 markets that are seeing, somewhere between 5 and 7% of supply growth per year. Austin, Charlotte, Nashville, Raleigh, uh, Phoenix, Salt Lake City. Some of these markets are just, because there's, investors see there's a lot of demand there. That's created a lot of supply growth. So, but now, last year with, rates being what they are, and suddenly, lending being a little bit more difficult to get on the construction side, um, starts dropped, about 40% year over year, and, on a national basis. Um, and a lot of the, the Sunbelt markets, they have a lot of properties in lease up. I think, there's about 600,000 properties that are in like lease up status across the country. But it's not spread evenly across the country. A lot of those are in the Sunbelt markets where rent growth has slowed. So if demand remains strong and supply growth continues to weaken, you know, I could see I could see rent growth in most of these markets returning kind of late this year, sometime next year, positive rent growth. However, right, that's a good, the best case scenario. That, if uh, because again, when we look at the supply growth going down, it's not level. Like, supply growth is going down everywhere, and we know, that there's a national housing shortage, right? Where several million units underbuilt in this country. But there are markets where, Chicago, for example, where there's just not nearly enough construction to meet the demand. But starts are going down in Chicago just as much as they're going down in markets that have a lot of supply. So, and, the markets that have a lot of supply growth, Austin, again, these Austins, Nashville, Charlottes, their deliveries are going down over the next couple of years, but not as much as, may be thought. But, we're still forecasting somewhere between 12 and 18% supply growth for some of these markets over the next 3 years. combined. So that's total, not per year.
Yeah.
But still, that's not, it's not like, wow, supply's falling off a cliff. There's no new, units going to be going into Austin next year. There's still going to be a pretty fair amount. And then, you calculate, then you have to add into that, will demand remain strong? I mean, it has, right? The economy, look at the job numbers are still positive month over month. But, when you look at the factors that drive demand, um, one of them is the housing market, right? People aren't selling houses because they have, like most homes have interest rates of like 3% or less. And so that's kind of keeping people in place. There's, a lot of underbuilding on the single family level, even more than multifamily. So, people aren't moving into single family houses like they traditionally have. So that I think will continue to be a driver of demand. Other, job growth is a driver of demand. Is that going to weaken? I think it was forecast to weaken even before we got into all the job cuts and the cuts in, federal grants and all that. So again, I don't think the economy, I'm not forecasting, the job growth is going to, we're not going to have like a GFC type collapse or a COVID type collapse, but maybe, it's going to weaken at the margins and it's not going to be as strong as it's been. Immigration's been another driver of demand, right? That's
Yeah.
obviously changed quite a bit. And again, whatever you think of immigration, as a political social issue, it creates demands, particularly in, the markets. There are markets, coastal markets, southern markets, New York, New Jersey, Texas, Florida, California, where there's a lot of demand that comes from immigration. And even if it doesn't, I know I've heard people argue, well, but they don't, immigrants don't move into kind of like the institutional properties that are in the Yardi database. And that's true. But, um, you know, if
But
they're
the market
moving in
it
somewhere,
affects.
yeah,
Yeah.
they're right, right. There's a filtering, there's a, an effect, the total,
Yeah.
demand. So
Just like we've
yeah,
seen, yeah, Class A, Class A, new supply of Class A has trickled down to lower rents and Class B and Class C apartments in many markets. The
right.
effect applies from the
Yeah.
bottom end up. Yeah, makes
So what,
sense.
just to finish my thought, I think the risks to the demand remaining strong are kind of, there's downside risks. So, um, am I bearish? Well, I'm not necessarily bearish about, multifamily, but I think that we're in a situation right now where, caution is warranted because, there's a lot of things that we're, undergoing a lot of changes and there's things that, could go wrong. And so, just be careful.
Yeah, that I think that's the most difficult part about where we are right now is that there's calls for potential recession but at the same time the underlying economy still seems to be relatively solid. I think we're waiting on a lot of new data to come in. There's a lot of variables and assumptions that continue to change. But it's hard to forecast and make plans. And one big change that we're currently reevaluating and underwriting is the discussion of a buyer's strike on U.S. assets and particular U.S. bonds. There was a weak 20-year bond auction last week, and it begs the question of us as multifamily buyers. If the rates continue to rise because of a lack of demand for U.S. bonds. What about that somewhat the historical relationship? I don't want to say true correlation, but the relationship between cap rates and interest rates, whether that be treasuries or U.S. corporate bonds, and if those yields of those bonds rise over time, does that allow or force cap rates to rise over time as well to maintain some sort of spread, because already we're at a historically tight spread between those yields. How do you see I guess continued volatility in the bond market and potentially higher for longer yields impacting multifamily values regardless of underlying fundamentals?
Yes, there's kind of two issues in there. One is kind of the long-term impact on bond rates and multifamily cap rate spreads. So just get to those one at a time. So I think that the negative impact of the policies that we've implemented um, are the potential negative impact is kind of in the longer term. So, tariffs and like, I don't know, who knows whether the tariffs,
Are they on or
yesterday,
off? I don't know.
yesterday they were on, today they're off, tomorrow they'll be on again. Certainly they're going to try, but besides the uncertainty of what they actually are from day to day, by creating uncertainty in the global economic market, by making, the US kind of a less of a safe haven, and it's, you know, bond investors, we're going to weaken demand for our bonds. All these years we've had this, people have said, the federal deficit is going to make interest rates go up. But as the deficit increased, interest rates went down, right? Why? Because the US was considered the most stable, safest place on the earth to invest your money. Um, that might not be the case going forward. That has a profound impact on, potentially higher interest rates over the long term. It's not like a day-to-day thing, but that's a potential problem. Not to mention that, if companies, again, don't see the US as a reliable company, place to do business, they're going to rework their supply chains, their business models to avoid, the US. And a lot of the things that we see as the strength of the US economy, our science, our, medical research, um, our intellectual leadership, if we if we, squander that advantage, then, I don't think that's good. But that's not going to show up in, the economic numbers this year. That's a long-term problem.
Yeah.
But then as far as interest rates and cap rates go, the relationship between those, and I think the key factor is investors' expectations about, NOI growth. So in a situation where, right, so we're in a situation now where, we have this really tight spread between, interest rates and cap rates. And I think that's because, most investors either they're paying cash, so they're not, financing, or, they're expecting rent growth to be strong over the next few years. So then that, that'll push their yields up. Um, but again, we've had nationally, well, less than 1% rent growth now for the last, couple of years. And, you know, I
I don't think
think
anyone's pointing to well above trend rent
yeah,
growth.
right. I mean, I think, well, there is some, idea that I've heard that, because of supply growth going down, that, we're going to see like a big boom in rent starting
Hmm.
in, like 26, 27. And, that may be, but I, look, the history of buying things with the expectation that rents are going to go up and you're going to make a lot more money in a few years. I mean, that's a risky thing, and historically that has led to a lot of, busts, including, the most recent, the GFC. That was, the problem. So it was one of the problems. But yeah, so
Well, another headwind to that argument, could be this talk of, a stagflationary environment of where we're seeing, costs rise, whether that be from tariffs or just continuing higher inflation, but we're seeing relatively slower growth. How does that environment impact multifamily? Are we seeing actual rent growth as part of that inflationary growth, but also expenses, and so kind of minimal NOI growth that we've kind of seen over the last few years? Or just curious your thoughts on, and maybe we're already in a stagflationary environment, but if we really kind of settle into that again, higher inflation but lower growth, how does multifamily fare?
I hear stagflation, and I'm old enough to have, remembered the 70s when, stagflation was a real thing, and
Yeah.
sitting on gas lines because you can only get gas every other day. But inflation was like really high back then, and economic growth was really weak. So, I mean, if you define stagflation as, inflation going up and, growth being kind of weak, I mean, I guess I could see that, but to me, stagflation kind of implies like dire economic conditions, like
Yeah.
really
High
crushing
unemployment.
inflation and negative economic growth. And yeah, I mean, look, the scenario that inflation's going to increase, maybe into the 3% range, and growth is going to be 1% instead of 2.5%. I mean, that's a possibility. I don't consider that to be, that's not my definition of stagflation, to be
Yeah.
honest.
Yeah. The only reason I brought it up is just in the recent Fed minutes,
Yeah,
stagflation, what was brought up,
yeah,
and it's been a recurring theme over the last several years. And I also think I agree with you. I think the definition has been evolving.
yeah,
Because when it was first really discussed, it was specifically the examples of the 70s that had extreme weak economic growth, really high unemployment, which we're still in an environment where we have relatively very low unemployment, and not a lot of signs that that's going to change anytime
yeah.
soon.
I could
Yeah.
see, kind of weak economic conditions, maybe a mild recession. I don't see, again, some kind of, catastrophic downturn in the near future.
Yeah, but more of if you reshuffle global trade and global financial systems, you there easily can cause some sort of distress and
Yeah.
downturn. Yeah.
And I agree. And I think that, what we're doing economically will have negative consequences over time. I just don't think that's going to be, in the next 6 to 12 months, that those things will show up in any of the data. Uh,
Yeah. I'm curious your thoughts on the discussion around some potential distress or percolating distress in the multifamily market. Certainly some delinquency rates still relatively low, but historically they are somewhat elevated from the past several years. There are some, high profile cases of some foreclosures going on, in this concept of kind of a wave, not really a wall, but a wave of maturing loans kind of coming due into this year, into 2026. Many of these were loans that had already been extended. Many owners, trying to survive till 2025. Well, 2025, and haven't exactly seen the NOI growth or NOI growth to get properties to a value position where they can successfully refinance or sell. But also interest rates haven't been cooperating. I mean, SOFR is certainly lower, but the 10-year is elevated, kind of hovering around that 4.5 mark. Do you see some forced selling at the end of the year? Will folks be able to work it out? Certainly, the banks don't want to see the distress. The banks don't want to take properties back.
I think there
Your
has
thoughts?
been. I think what's
Yeah,
happening now is, right. So you have a lot of loans coming due, and as I mentioned before, there's a lot of capital that wants to invest in multifamily. Or I can't remember if I
true.
said it, but I think I said it before. And so I think what's happening is where the loans are coming due, and right, we've had loans that have been extended, and they can't keep getting extended forever. But the transactions where there's just no hope of extending in any reasonable way, I think there's a lot of one-off transactions. Banks aren't selling, billion-dollar portfolios of bad loans like some people were thinking a couple of years ago. But at the same time, I think there's a lot of under the radar activity, individual deal level basis. Somebody's, stepping in, providing, mezzanine debt or preferred equity, or, they're just, you know, restructuring the ownership, bringing new owners in. There's some kind of forced sale, but it's not being done, you know, out in the open. It's not. I mean, it's being done on a one-by-one basis, so it's not like creating like a lot of news.
It seems like the whole situation has been relatively well managed and controlled, at least up to this point in time. In that there have been bank properties gone back to the lenders and banks. There have been some foreclosures, but they've really been rolling out, and the ability to extend many of these loans has at least had the ability to kind of spread any potential distress over a period of time. And I think that's a good point, that a lot of this is just happening kind of behind closed doors, getting worked out, because there is a
And
bid on multifamily.
right, so in like 2006, 2007, you had like 99% financing. So if property values went down 25%, well, there were
Yeah.
these mezzanine, the lenders, taking a big hit. Um, in this case, the value drop has not been quite as extreme. The leverage involved wasn't quite as extreme. So the losses where they're happening are largely on the equity, I think.
Yeah.
And that, so individual, equity sources are losing money, and that's not quite a, systemic kind of a problem as banks failing and that kind of stuff that was happening in past cycles. So yeah, I think there has probably been an increase in loans being restructured and taken over, but it's just not as dramatic as it could have been under different circumstances.
Yeah, probably not as systemic. I know you also cover kind of the build to rent space, kind of the single family rentals as well. Have you seen any differences, I guess, in the single family rental space, relative to multifamily?
Well, the SFR space, I mean, it's much smaller. It's a fairly new, by the scheme of things. It's been around for 15, 17 years or so. And the scattered site part of the business, which was really big a few years ago, I mean, that's kind of fallen off because of interest rates and just for a lot of reasons. It's just not as it does, the numbers don't work the way they did when mortgage rates were 3%. So the growth in that industry is now mostly coming through build to rent. And I also I think that also makes sense from the owner's point of view, because managing a portfolio of scattered sites, no matter how efficiently you do it, is a lot more complicated and costly than managing a bunch of properties that are all in the same location. So I think that and then there's some political pressure on scattered sites. I don't think that's why that part of the business has slowed down, but um, it's an industry, I think, that's here. I think it's growing. I think that demand for single family homes, single family rentals will continue to increase. As I've said before, that there are a large number, a growing number of people growing number of households that want the amenities of a single family home, but don't necessarily want to own, or you can't afford to buy. So I think that will produce strong demand for SFR, BTR for the foreseeable future. There are, and it's, considering it's a small market, so we're seeing a large growth in, SFR, in individual metros, but it's still strong. So I don't think that, when it has the same kind of, oversupply issues that you have in multifamily. There are markets where there's just a lot of rentals of
Yeah.
all types, and that, that's weakened the occupancy rate in some of those markets. But I don't know, it's a product that I think is necessary, and I think that institutional um, BTR owners solve an issue of this is something that people want. So I think that it will grow and be successful, but it's still kind of a niche market. And, BTR is by its very nature a very, kind of slow growth, because you need a lot of land, you just can't build it anywhere.
Yeah, it is interesting that seeing the growth of the built to rent segment, and on this topic of renting versus buying, with single family homes, the ability to get a mortgage being out of reach for so many individuals that may have been in the renting by choice are now finding themselves in the renting by necessity category. They just can't purchase that home. Do you see this historic widespread between buying and renting maintaining, or will somehow rents come up enough, or home prices come down, or interest rates come down to narrow that spread? What is the, I guess, the long term outlook for the spread between renting and buying?
Yeah, I mean, historically, they tend to converge. So I would be surprised if the gap remained this high as for a really long time. That said, I mean, I don't know exactly, right? I don't think, rents are going to go up 50% to,
Yeah,
to get closer to home costs, and the home market, I don't think, we don't, you know, prices aren't going to drop, 30-40%. That would be kind of catastrophic. And so then the other part of that is, interest rates, and, we don't, our control over interest rates is not, is kind of not great.
good
So
luck. Yeah.
I don't, yeah, I would say of all those three that, the thing that's the most variable right now would be interest rates, but it doesn't, I'm certainly not going to predict that we're going to, drop 200 basis points off of the, the treasury rate, or, the mortgage rates are going to go down in quickly in the near future. So I think, at least in the short term, we're going to see this wide gap.
And if that persists, I mean, that's a big positive driver for multifamily and all sorts of rentals, is it not? Over the
Yeah,
long term?
no, yeah, it is. And, that was one of the things I talked about at the beginning of the conversation. Yeah, so that is in fact a driver of multifamily demand that I expect to persist for the near future.
Yeah. Anything else, Paul, that you are seeing that kind of either that you're focused on, see any trends that are emerging that you don't think get enough attention?
Well, one of the things that I've been focused on this last year has been on the affordable market. We integrated, we have a fully affordable component to Matrix now that we've, just developed, it's just put into the system in the last year. So I've been doing a lot of research on the affordable market, and, looking at trends in that area. And, I think with, to get to what we're talking about here, the high cost of housing, and the number of renters that are paying, high percentage of their income. It's a national issue. It became an issue in this most recent, election that we haven't seen in a long time. So a lot of jurisdictions, states, and municipalities are requiring, some affordable components to developments. We're seeing interest in things like, light tech and opportunity zones, which also are in I didn't mention it before, but opportunity zones, which is kind of a tax break for developing in low income areas, that has created, was in effect over the last 10 years, and is going to be renewed probably in the next budget bill we get. So there's a lot of momentum toward, trying to find solutions, encouraging some kind of affordable subsidies. And I think that market rate players, it's kind of incumbent on them to probably learn more about the affordable, development, and to incorporate, you know, affordable strategies into their business models.
That makes a lot of sense, and I think for a lot of developers and market rate participants, I think they're just intimidated because it can be slightly more complex and it's just a slightly different strategy. But there is a huge opportunity that's worth taking a
Yeah,
look
and
at.
it is complex, and the the increase in costs, construction costs, land costs, everything, that affects affordable too. So, we have, subsidies to build affordable, but as the cost of development goes up, those subsidies, buy less, fewer number of units. And so affordable developers have to sometimes layer on subsidies. And like you said, that makes it more complicated. And that's unfortunate too, right? I mean, it really, there should be, we should be developing more simple ways to build affordable housing. And there are people, working on that. But, for the time being, though, it is complex. And, but, the number of affordable units being built, is a greater share of total multifamily development now than it was, say 5, 10 years ago. So again, I think that, market rate developers are probably going to, either want to or have to, get more involved in that part of the market.
Yeah, well, and like you said, in many new developments, municipalities are requiring some set aside of affordable units. So if you're a developer and you're not familiar, it's time to kind of get up to speed because most likely it's going to be incorporated sooner rather than later. Well, Paul, this has been a great conversation. Love to have you back on the show. How can folks learn more about Yardi Matrix, your publications, and what should we expect for you and your team to put out here in the near future?
Well, I have an affordable housing bulletin coming out, I think today or tomorrow.
There we go.
Yeah, so it's in this bulletin that we tracked loan maturities, when they're coming due, of maturities of fully affordable properties, and then I say capital A affordable properties
Hmm.
that have some kind of subsidy. What How much volume is maturing per year, the lender types that, and the which metros and the borrower type. So, some of that, we have a bulletin on that. We're probably about a week away from our next monthly multifamily report. I think that the numbers are just about to come out. So we publish a steady stream of research, and it's at yardimatrix.com/publications.
Well, viewers, listeners of the Gray Report are very familiar with your research. We very frequently refer back to it. It's great work that you all do, highly informative and highly useful for our team, and I know valuable to our listeners and viewers as well. So, thank you, Paul, for all the work that you all do and putting out some great research.
And thank you. I really enjoy talking with you, Spencer, and can't wait to do the next one.
Awesome. Let's do it. All right, Paul, you have a great day, and thanks again for coming on the Gray Report.
Okay, bye-bye.
Okay, bye.